In recent years, governments around the world have been printing more money than ever before. From economic crises to global pandemics, many countries have turned to large-scale money creation as a way to support their economies, stimulate growth, and prevent financial collapse. But while printing money may seem like an easy solution, it can also bring serious consequences such as inflation, rising debt, and weakening currencies. So why are governments relying on this strategy so heavily today? And what does it mean for the future of the global economy? In this video, we'll explore the reasons behind the surge in money printing and the impact it could have on our everyday lives. Today, we will talk about why governments are printing more money than ever before. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction: the global surge in money creation. In the modern global economy, governments and central banks have dramatically increased the amount of money circulating in financial systems. Over the past 2 decades, especially after the 2008 global financial crisis and the COVID-19 pandemic, central banks around the world have expanded the money supply through policies that are often described as printing money. In reality, most of this money is created digitally by central banks and injected into the economy through financial institutions. The main goal is to stabilize economies during crises, encourage borrowing, increase spending, and prevent economic collapse. However, the rapid expansion of the money supply has sparked widespread debates about inflation, debt, and the long-term stability of global financial systems. Understanding why governments print more money today requires examining the economic pressures, political decisions, and monetary policies that shape modern economies. 2. The role of central banks and monetary policy. To understand money printing, it is essential to recognize the role of central banks such as the Federal Reserve, the European Central Bank, or the Bank of England. Governments themselves usually do not physically print money to pay their bills. Instead, central banks increase the money supply through monetary policy tools. One of the most important tools is quantitative easing, QE, a policy in which central banks create new money to purchase government bonds or other financial assets. This process injects liquidity into the banking system and encourages banks to lend more money to businesses and consumers. As banks lend more, the overall money supply in the economy increases. The purpose of such policies is to stimulate economic activity when traditional tools, like lowering interest rates, are no longer effective. Through these mechanisms, central banks attempt to maintain economic stability, reduce unemployment, and encourage investment during economic downturns. 3. Economic crises and emergency stimulus. One of the main reasons governments print more money today is the need to respond to economic crises. When economies face major disruptions, such as financial crashes, pandemics, or wars, governments must intervene to prevent massive unemployment and business failures. During the 2008 financial crisis, many central banks launched large-scale stimulus programs to support banks and financial institutions. Similarly, during the COVID-19 pandemic, governments around the world implemented huge relief programs to support households, businesses, and healthcare systems. Because tax revenues often decline during crises, governments rely on borrowing and monetary expansion to fund emergency spending. Printing or creating new money allows governments to inject billions or even trillions of dollars into the economy quickly. These measures aim to maintain consumer spending, prevent economic collapse, and ensure that businesses can continue operating even during severe disruptions. 4. Supporting economic growth and preventing deflation. Another reason governments expand the money supply is to support economic growth and prevent deflation, a situation where prices fall across the economy. While falling prices might seem beneficial to consumers, deflation can actually harm economies because it discourages spending and investment. If people expect prices to keep falling, they may delay purchases, which reduces demand for goods and services. Businesses then produce less, leading to layoffs and slower economic growth. To avoid this cycle, central banks increase the money supply to encourage spending and investment. As economies grow and produce more goods and services, more money is needed to facilitate transactions. If the money supply does not expand alongside economic growth, the economy could face liquidity shortages and financial instability. Therefore, increasing the money supply is often seen as a necessary step to maintain a functioning and expanding economy. 5. Government debt and fiscal deficits. A major factor behind increased money creation is the rising level of government debt around the world. Many governments spend more money than they collect in taxes, creating budget deficits. To finance these deficits, governments borrow money by issuing bonds. Central banks sometimes purchase these bonds as part of monetary policy, effectively creating new money in the process. This mechanism allows governments to continue funding infrastructure projects, social programs, defense spending, and public services without immediately raising taxes. However, relying heavily on money creation to support deficit spending can be risky. Excessive expansion of the money supply can lead to inflation and reduce confidence in a country's currency. If investors believe a government is printing money irresponsibly, they may stop buying its bonds, which can lead to financial instability and currency depreciation. 6. The relationship between money printing and inflation. One of the biggest concerns about governments printing more money is inflation. Inflation occurs when the supply of money grows faster than the production of goods and services. When more money is chasing the same amount of goods, prices rise across the economy. This reduces the purchasing power of money, meaning people can buy fewer goods and services with the same amount of income. High inflation can have serious consequences, including rising living costs, reduced savings value, and economic uncertainty. It can also force central banks to raise interest rates, which increases borrowing costs for households and businesses. While moderate inflation is considered normal in healthy economies, uncontrolled money printing can trigger severe inflation or even hyperinflation. 7. Historical lessons from excessive money printing. History provides several examples of the dangers associated with excessive money printing. One famous example is the Weimar Republic in Germany during the early 1920s, where the government printed large amounts of money to pay war reparations and support the economy. This led to hyperinflation, where prices increased so rapidly that the currency became nearly worthless. Similarly, countries such as Zimbabwe and Venezuela experienced extreme inflation after governments printed large amounts of money to cover economic deficits. In these cases, the value of national currencies collapsed, savings were wiped out, and economic stability deteriorated dramatically. 8. The future of money creation and economic policy. As global economies continue to face new challenges, including climate change, geopolitical tensions, rising public debt, and technological transformation, governments will likely continue using monetary expansion as a policy tool. Central banks must carefully balance economic stimulus with the risk of inflation and financial instability. Modern economists increasingly emphasize coordination between fiscal policy, government spending, and taxation, and monetary policy, money supply, and interest rates. While printing money can provide short-term relief during economic crises, it is not a long-term solution to structural economic problems. Sustainable growth ultimately depends on productivity, innovation, and sound economic management. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment